Roku hit an all-time high of $473 a share. It is currently at 58, and Cathie Wood says this stock can reach $605 a share in 2026. In this video, I am going to determine Roku's valuation by looking at the price to sales ratio and comparing it to other companies in the sector. Then, I will use my Excel spreadsheet to calculate Roku's intrinsic value in order to determine if you can make good money by buying this stock today. Roku is not a profitable company, so a good way to value Roku is by looking at the price to sales ratio and comparing it to other companies. Roku is a streaming platform, which is a sector with a lot of competition. Roku has a price to sales of 2.8. and Netflix, for example, has a price to sales of 4.7. And I cannot compare Roku with streaming platforms such as Disney Plus or Amazon Prime because Amazon and Disney are companies that have other businesses, and Roku is solely a streaming platform. However, I can then compare it to companies that have a similar gross margin. Roku has a 46% gross margin, and a company like Microsoft has a 68% gross margin with a 10 price to sales. So overall, from a price to sales perspective, Roku looks good, honestly. Then, to calculate Roku's intrinsic value, I used my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions you put in. So on screen, you are seeing my 7-year assumptions on Roku. The hard part about valuing Roku is to determine what numbers you put in for profit margin and free cash flow margin, because they don't have profit or free cash flow yet. So I went with the margins of a company like Netflix and I decreased them, because this Excel sheet assumes that they have the numbers you put in since day one. So you have to make an average over the next 7 years, and they are expected to become profitable in 2026. I also went with wide ranges because there is a lot of unknown about the future cash flow and profit of this company. So taking all of this into account, if you believe my high assumptions, you would buy the stock all day long, as you would make 25% return every year. If you believe the middle assumptions, you could also buy the stock, as the stock price is basically there. And if you believe the low assumptions, the stock needs to fall in half. I am personally going to pass for the moment on this company because it's not heavily undervalued and it's still a young and risky company. However, this company reports earnings on Wednesday, and if the stock price drops, it might be a good opportunity. I hope you enjoyed the analysis, and I'll see you on the next one.